FTAI Aviation jumping nearly 7% today, continuing to climb back from its lows of the year. Shares of the aviation leasing company took a tumble last month after two short sellers alleged it had misrepresented earnings. Even with the recent rebound, it's still down more than 35% from record highs. But Jeffries just did its own forensic analysis of the company and thinks there are big gains ahead for FTAI. Sheila Kayalu is Jeffries' aerospace and defense analyst. She joins us here on set. Sheila, great to have you with us.
Thanks, Melissa. Thank you.
So you're basically attacking sort of one of the biggest pillars of their report, and that is that they are misrepresenting what they are selling.
Yeah, I think what fundamentally FTAI does is provide power by the hour for airlines. And that's through leasing, exchanging, or repairing their engines. And they're doing it, and they're growing EBITDA 45% per year. When the stock was up 180% last year, it made them an easy target for the shorts.
Yeah, I mean, what one allegation was that they were buying engines, or they had bought engines during COVID, so they're depressed values. Nobody wanted these engines. And then they were reselling them at current market prices, and so they were sort of misrepresenting because it wasn't a normalized situation. But you say that that's not actually the case because they actually increased their inventory well past COVID.
Yeah, that's actually misrepresenting FTAI's business. So they do have engines in their leasing portfolio that they bought in 2021, but those engines are 19 years old, and they depreciate them down to full value. So basically, these engines are then transferred over into aerospace products, and they're at a fairly low residual value. So the thesis that they pre-bought engines and they're skimming this margin is not what FTAI does. FTAI repairs engines, and they do it at a discount to the major OEMs like GE and Standard Aero, and that's how they make the margin that they do. But the leasing portfolio provides that feedstock and that flywheel to be able to do that. But they're not in the business of exchanging engines, and because their engines are appraised every 6 months, they wouldn't be able to incur that benefit because it's part of their cost of goods sold in our analysis.
Right. They report earnings at the end of February. Do you think they're going to have an update on where they are in their own analysis in order to sort of clear this all out?
We see very quick catalysts ahead for this stock. You know, we're going to. There's going to be earnings on February 26th, and their deadline to file their 10K is on March 3rd. So those are two things we are keeping an eye on to clear the air on what FTAI is doing. And we have $850 million of EBITDA in 2024. We have that going up 35% per year to 1.5 by 2026. So you could see why this has caught the attention of the shorts. How are they growing earnings so quickly?
Let's broaden it out a little. Your sector was on fire into the fall of last year. And I don't want to play stock market, but names like Lockheed Martin went from 610 to 450, Raytheon. The whole sector just got whacked on a bunch of different reasons. Have these names gotten to levels where just valuation alone makes them compelling?
My calls primarily focus on airlines and aftermarket. Defense names, we don't really have buys, 3 out of 13 buys in the group for defense names. The reason why we like the aftermarket is we've under-delivered planes by 3,000 aircraft since 2020. It's really easy. And the CFM56, where FTAI focuses on, is 50% of the engines globally. So that's where they're repairing engines. So names like GE, HEICO, TransDigm, FTAI, we're all about, and throw in United Airlines as our top airline pick. So those are the names I support versus defense, where even if revenues are growing, EBITDA is not growing above revenues. And that's a hard stock to own in our view.